All right, Queen's Court.
Mm,
I've got a very important question that not only I'm asking for myself.
okay.
See, I am a very generous queen. I don't come here with just my own specific needs. I listen to my people. My
Hmm.
people bring me questions and I bring them to you as well. So you can help me and so I can help my people.
Hmm.
So I'm looking at two Tackle 25 companies. I'll give you the ticker symbols, Bank of
Okay.
America and Ford. And here is the question. Specifically on Bank of America, we're starting to see the nice little bounce back off of the moving averages. Of course, we've got to
Hmm.
clear that 47 clip there, but I've got it covered right now. But I'm wondering, and not only me, but my people
Hmm.
are wondering, is it time to uncover and let this bad boy run so that we can recover a little bit of what we gave up while we were on a downtrend?
So if you're the queen and I'm the court gesture, does that still mean they're my people too?
Uh, they're my people.
Okay, they're your people. All right. Okay, I think this is a absolutely amazing question right now, and probably the number one question on people's minds that do a lot of covered calls
Mm-hmm.
is when we've been in lockdown mode, right?
Yep.
We've been in lockdown mode, and we've been in lockdown mode for a month in covered
Mm-hmm.
calls. Like when in doubt, write that call,
Write it up,
right?
write it up,
When
write it
in
up.
doubt, write it again. If it goes down aggressively, buy it back at a cheaper price or write another
Write it
one.
again.
Lockdown mode, right? Lockdown mode is max cash flow. Maximize the cash flow on covered calls. So we've been in a little bit of lockdown mode in covered calls, and now that the market is recovering a little bit, we're starting to punch up, right? And it's one of those competing philosophies, right? Because you want the market to recover and you want the market to start trending good, but you don't want it to do so well that it goes above your $48 strike price that you sold and maximizing your cash flow. So it's a good number one, it's a good problem to have, right? It's a good decision to have. It's the more complicated decision, but it is a good decision to have. And what I mean by that is when it comes to the management of covered calls, you got to manage two competing things. Number one, on the downside, what you're really managing is what I refer to as the efficiency of money. You've written the call for a buck. It's now worth 20 cents. There's been a week that has transpired since you wrote it.
Mm-hmm.
Buy back the call. There's no reason to stay in the trade another 21 days to make the last 20% of the trade when you already captured it 80% of it in the first 33% of the time frame. And so
Yeah.
the efficiency of money, it's really simple. It's when the call goes down to a certain level against the liquidation value, which is just the value of the call option. That's just a creative way to say the cash flow that you received. Well, you buy back the call. On the top side, it's a little bit more complicated. It's a little bit more complicated. Now, what I would say is there's not a way that you can remove all the subjective decision making. We have to make subjective decisions here. And so it
Mm-hmm.
really goes to your confidence in achieving certain things in this space. And so, question for you, young lady, my queen, what strike price did you sell, and what month are you currently working in? Just to make sure what I'm saying is accurate.
Okay, I sold the 48 and I sold the weekly March 4th. So I've still
Okay, so
got 31 days left to go.
so you basically wrote this last a week ago,
Yeah,
right? So
literally.
you're like lockdown mode, write that covered call, and we'll
Yep.
deal with the upward movement of price if it occurs. Love it. Love that. Love the decision. Love everything about it. Now, a couple things. Number one, great job selling the 48. Great job selling the 48. If you sold the 47, you would be hating yourself right now because, like, literally, you're like, I got to buy back the option and it's not even breaking out yet. What are we doing here? You sold at a level that makes the decision easy for me. You sold at a level that we call resistance, that if that you want to let resistance work, because if
Mm-hmm.
it breaks out of resistance, the decision becomes easy, right? You at that point, whether or not it does it is a different story, but you have to be projecting higher prices at that point, right?
Yeah.
I'm not certain you can say that right now on Bank of America. Not when the overall trend in Bank of America is fairly neutral over the course of the last, 3-4 months in the marketplace, with the top end outside of the, starting point of this year, with the top end channel right around that 48 handle. So number one, selling that call option at 48 versus 47, you took a little bit less cash flow, but you maximized your decision from a technical perspective, because at 47, I'm sorry, with resistance at 48, you don't want to buy back that option at 47, because you're psychologically, you're going to be like, but 48 is going to hold and it's going to come right back down, and it might not. But, I mean, psychologically, just you start doing the dance, right? You start doing the dance of maybe if you would have, could have, should have, all this, and all of a sudden you just make bad decisions. And so selling that 48 call option, it really does help you. And again, you're giving up a little bit of cash flow there, but it really does help that decision, number one, because I don't think you do anything under 48 here. I really don't. And the reason I say that is, you're showing a loss on the call here. You wrote the call last week. You're showing a loss on the call right now. But you're more than making up on that on the stock price.
I know.
And so that's a good problem to have. Let that $48 call option do whatever it wants. It's going to go up and down based on delta. And especially in the first week of the trade, it's going to go up and down on delta far more than any other option Greek, right? Theta, whereas delta is the rabbit, the hare, theta is the tortoise, and theta is going to take a little bit of time. But if you make a decision just to get out because it's going up, you're not giving theta any amount of time to work here. You're basically just saying, delta is going to win out and I'm going to run for the hills. No, you're still within the range. And so number one, it does make it simpler to sell that level at 48, because then again, you're just basically saying anything under 48, I'm sitting on my hands. I'm not going to do anything. It's the range. And we got a little bit of a short-term breakout at 47, right where the 20-day moving average is. And that certainly could prove it to make the run into 48 and ultimately break that 48. Awesome. Fantastic. If that happens, you own the stock. Good for you. But the reality is anything between 47 and 48 is just going to work into the top end of the resistance zone. And so I like the decision, number one, to sell the 48, because that decision makes the management very easy. 47, we have a different conversation here today. But the technique I want you to start focusing on is basically you've said I'm good under 48. The question is, what do you do if it goes above 48? That's the ultimate decision, is if it goes above 48, do you open up that risk graph and let it fly? Yes, but maybe. And I know people hate that, but
yes,
the maybe has math to it, and that makes it simpler. So if the intrinsic value upon the breakout of the call option is still higher than the extrinsic value, then you probably buy it. Then you probably buy it back and let that puppy run.
Okay.
It just depends, and that will depend on the strength of the breakout, quite frankly. If it breaks out by 10 cents, you're only going to have 10 cents of intrinsic value. There's not going to be anything there. Once the intrinsic value is above the extrinsic value, you probably want to take the loss on the call and let the stock fly. And so if it goes, say, 10 cents above 48, you again only have 10 cents of intrinsic value there. If you still say have 70 cents, and right now you don't have anything intrinsic right now because it's an out of the money call option. And so when you come to where it says intrinsic value, 48, you see the intrinsic says zero. There's nothing there, because again, stock price is at 46.65. You sold the call option at 48. There's no value to a $48 call option. It's all time value. And so right now, if you buy back that option, the only thing you're saying is, I don't care about my time. When the entire purpose of selling the call was you care about your time. So there's nothing intrinsic yet. There's no value to the call option, Why are you buying back air? Because that's all that you're doing, right? Once it gets above 48, what you'll see. So, for example, Em, let's say you sold the $46 call option instead of the 48. Okay. Well, if you had sold the $46 call option, you now have 66, 67 cents because, again, you're 66 cents above the strike price, right? So you have 66 cents of what is now intrinsic value, but you still have $1.15 of extrinsic value. And so even if you broke out today and you had sold the 46, guess what I would say? Give it another day. Let's see. Let's give it another day. Let's see. But psychologically, you're just doing a dance in your head because you're like, oh, I'm losing money on the call, but you're gaining money on the stock. So calm down, right?
It's the talk guard that we talk to ourselves.
We do it all the time. I do it. You do it. Everybody does it all the time. That's why we're having a detailed conversation on it. But again, this number here, the entire purpose of writing the call option is so you can maximize the extrinsic value of the call.
Yep.
And so with the extrinsic value at 112, the intrinsic value is 66. I think you'd be given into the behavioral and psychological analysis of loss when you don't necessarily have a loss. You always have to look at the combined position and not just the one position. And so when you're looking at it from a net position perspective, the data suggests you shouldn't do anything until it goes above 48. But even if you had sold the 46, I would still say sit on your hands until we see that intrinsic value exceed the that gets caught a little bit. When the intrinsic value exceeds the extrinsic value, at that point, you probably have enough momentum in the movement of the stock to say, let me open up that risk graph and take the risk to the downside.
I appreciate that. I got one more. It's going to be a quick one on Ford. And I know the answer to this.
Are you sure?
Are you sure?
Ford has earnings. There's nothing quick here. You know what you get.
Well, I know you're going to go into teaching mode, which I certainly appreciate, and my people will certainly appreciate that. So same question on Ford.
Okay. Now the question on Ford, you can't navigate this question without talking about earnings.
Exactly.
Okay? We covered call traders have to navigate earnings the same way everybody else does. Now, the question is always going to be, do you collar? Do you simply protect, or do you do nothing? There is not an equation that says, do you simply do a covered call? Okay, that's number one. We do not hold closed down risk graphs with open-ended loss risk graphs in earnings. That's basically saying, I'm not willing to make any money to the top side, but I'm willing to lose it all to the downside.
Everything to the downside.
Like it's the polar opposite of everything any trader and investor has been taught. It's the worst thing possible when it comes to earnings. You literally would rather be naked on a street corner selling naked calls on natural gas in an inflationary environment. No, I kid, maybe not that one. But point is, you just don't do it. Okay, it's a no-fly zone. You do not do it. You do not carry a covered call through earnings without collaring the trade. So the question really becomes, do you leave it naked and reassess after earnings because you are in this fundamentally? You are not in this technically. This is an investment. This is I'm investing in Ford for a very, 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 very long time. Right? I'm not going to get out simply because it spooks me on one earnings season because I'm not a snowflake, right? It's that type of mentality. Okay.
Yes.
So now that we're on the same page with that, because you got to get out of the short-term mindset sometimes, right? You got to think long-term. Well, the question therefore becomes, do you want to take the earnings risk out of the equation? Right? You want to remove that from the equation. And that's either a collar or no collar. Okay, that's the question. To collar or to not collar. Now, to collar means we have to understand what a collar is. A collar, C-A-L-L-A-R, a collar trade is when you both do the covered call and the protected put. And so you're basically so you're basically doing three things. Okay. And I'll simulate this on the risk graph if you don't mind. Okay. And I know you said quick question, but that's not a quick, I'm sorry. That is not a quick question.
If
That
you had
is a
AT&T for 5
complicated
hours,
question,
then we would
right?
have more time to talk about this. But go ahead.
Listen, I have things to say about AT&T, young lady, and I'm not done with AT&T.
Come back.
Okay?
I'm sorry. I did not mean to
There
trigger
you go.
you again.
Okay. So Ford, the first thing we have, right, is we have, and let me get out of the trade tab here so we can simulate what this actually looks like. So the first thing we have here is we have long stock, right?
Yep.
And that's what the risk graph looks like on a long stock. It's open-ended. It opens up to the top side. It's open-ended to the downside. Stock can go up forever. Stock can go down to zero. Okay. So it's what we call vertical. Well, when you want to write a covered call, you're basically locking down the right-hand side of the risk graph. And as you lock down the right-hand side of the risk graphs, let's say we go out to that 31-day contract and let's just go sell the 22 call option here. Okay. So we're gonna sell that $22 call option there. You see that? We're gonna bring in 64 cents of cash flow here. Now coming back to the risk profile, what you now see is the right-hand side of the risk graph is locked down, because by writing the covered call, you were telling Mr. Market, whom that's who you're trading with here. You're trading with the millions of other market participants out there. And if anybody ever asks who's going to buy that call, I'm going to tell you, I don't care. Go talk to somebody who does. So in terms of this, we're selling to the marketplace. The $22 call option was giving somebody the right to buy your stock at 22. Well, if it goes to 30, somebody still has the right to buy your stock at 22. That's why your risk graph is locked down at 22. Now, we never carry this risk graph through an earnings position because an earnings is a 50-50 crapshoot, and we have no edge there, right? And so what we want to do is we want to either one, lock down the left-hand side of the risk graph, similar to what we're doing on the right-hand side, to remove the volatility, whether it goes to $10 or $30, we don't care, because we are at that point locked down. We're in lockdown mode, right? Full lockdown mode is collar trade. Okay. Yep. And so we're in lockdown mode. So the question is, are you concerned enough with Ford's earnings report right now to go into full lockdown mode? Or does Ford have a history that you're okay with from an earnings perspective? And so the question is really, do I lock down completely and try to remove the volatility from the movement completely, which can be achieved here? Again, if we want to go full lockdown mode, let's just say, and again, I'm just going to simulate here. So let's just go buy the $19 put option here. Let's go back to the risk graph and, oh, wait, no, I doubled up to catch up there. Words matter. So do clicks in a broker. Okay. Yep. Words matter. So do clicks.
Red means sell.
You definitely do not want to ever write a covered call, then write a naked put and hold mistakenly through earnings. That is something we never, ever want to do. Words matter. So do the click. And we're going to click on the long put there, 72 cents. Let's go to the risk profile. Now, what did we achieve? Full lockdown.
Look at that.
Full lockdown. We're done. We don't care. And it only took a very complicated skill set to get there, but we did it. Achieved it. Lockdown mode. We're fantastic. Now, that's if you are concerned about earnings. And that concern could be, oh man, the market's been volatile recently. That concern could be, oh, Ford's done great in the quarter, or it could be one of a million different things. It's your concern, right? Your concern is. I want to hear it.
My concern. So all year long, last year, naked puts on Ford because I wanted to get a sign, didn't happen. So 2020, 2022, it's on the tackle 25. I'm right. All right, we're buying. So this is the first year I have this baby. This is a very, important baby to me right now. It's still an infant. So going back and just looking at previous earnings, right? It doesn't usually gap, and if it does, it's not huge, but it's the first time I'm holding it through earnings. So I do have a little bit of concern because I have not, it's not Bank of America where I know what Bank of America does and behaves, right? So for me, my concern is it's the first time I'm holding the baby through earnings. So I kind of feel like I want to do the collar.
Yeah, I can understand that. I can understand that. You don't want to, yeah, you just made a decision to get married. I get it. You don't want to, you're not ready to go to Vegas and see
I
what
don't want to go
happens.
have an
I
annulment on
get
this
it.
marriage. We just got married. I don't want to get an annulled right away. So
Yeah,
I'm
you,
trying
you
to
don't want you don't
this
want to have that. You don't want to have that in your life. I understand that. You don't want to meet somebody a week later, be like, "Oh man, serial killer." Probably should have hesitated on this one a little bit. I totally understand the mentality. I
because we know
100% get it.
Murphy's law. Murphy's
Listen,
law is like, okay, I'm not going
if
to do
you can
anything until yeah.
remove the volatility from your emotions by removing the volatility from the position, I am all for it. And that's what we do, right? Because
Hmm.
again, if this relationship is going to work out, it's going to work out on both sides of the ledger. And that's not just Ford's volatility, that's your own volatility as well. There's a two-sided coin there. It takes two to tango. You know that saying, right? That old cliche. It takes two to tango here. Well, your volatility might be more than Ford's volatility in this emotional conversation. And so what I
Hmm.
would say is if we ever feel the need to remove volatility, especially in times of volatility, there is nothing wrong with collaring the position, even if the data suggests you shouldn't. And so let's look at Ford from a data perspective. Number one, Ford gaps up from about 1550 up to the closing price or the next opening price about 1680. And so, you have a fairly aggressive 7, 8, 9, 10% movement on that earnings announcement. On this one, we also deal with a gap up type scenario from 1380 all the way to about 1450. So, not a knock your socks off type movement, but a pretty aggressive movement for a cheap stock. I mean, that's not moving like Netflix type volatility, but it's also pretty aggressive for a cheaper stock like that. Ford here has a little bit of a gap down and a run down here as it went from 12 Ford closing price down to around 11. So about an 8% movement on there. So I do feel like Ford, especially with where the market is and what the market is doing, I feel Ford can certainly move a good 7, 8, 9% on their earnings. And I don't feel that's we got 60% potential to gain 8% and a 40% probability. No, I think it's 50-50, 8% up or down here. And so, based on that type of movement, we're not even talking Apple's 5% typical. You can expect a little bit of price movement here on Ford. Ford's projected to move around 5%. I project a little bit more personally, I project a little bit more volatility on Ford's than the 5% price movement that the market is expecting. And so I certainly do feel like the data suggests that you should, not that you should, but that if you made the decision to call there, I do believe the data does support that. But then again, in the back of your mind, you're like, but did you see Exxon do what Exxon did today? Right. And so I just feel like if the purpose is for the covered call, and if you're looking to cash flow 3% ROI on a monthly basis, I don't feel you should get greedy over an earnings announcement.
Yeah.
You know what I mean?
Mm-hmm.
So the question I have for
Decisions,
you, young
decisions,
lady, is
decisions.
based on our conversation. What are you going to do on Bank of America? You let the
Well,
puppy
that
run?
one, yeah, no, I'm gonna keep it until it breaks out of 48. Because again, all trading requires is just to talk it out with somebody else so that you can go back to your initial decision in the first place.
Yeah.
Why did I
You
start with
just you
48?
just want a sounding board, and my 45-minute conversation was that sounding board.
So
So
Bank of America,
I had to go into teaching mode. Those are good questions that I feel need detail to the answer so that we can
yeah, and
understand,
and
right?
everybody is thinking that question. And sometimes, team tackle, we know who are avid team tackle students are. They'll ask all kinds of questions, but we have those, they're just kind of quiet in the corner like little shells, and they don't want to
Hmm.
ask a question because they think it's a silly question. And there's no
So
such thing as a
quiet
silly
like you and
question.
I, like you and I are quiet. I agree.
Yeah, like
Yeah, yeah. See how
so,
see how it's done.
I'm considering my people who are quiet and shy, they want to ask it, but they
Hmm.
don't know how, they don't want to. So That was for my quiet people that were thinking the
Well,
same thing but
for
didn't
your quiet people, I hope that my thorough, detailed answer did help them navigate that question. So, but it's a question that we all have right now in having open discussions about the decisions that we make as individuals. It sometimes is not easy because it opens to criticism, but simple reality is we have to talk these decisions out. And I just feel like as we talk, as we sometimes, Emily, like, I'm not kidding. Sometimes in the halftime report, I'd like, oh, I'm just having a conversation with Emily. Like, you just have conversations, right?
Yep.
And you work out detail, and hopefully people can, it can help them a little bit make some of the same decisions that they are faced with making as well.
Absolutely. I could not agree with you more. So thank you very much for that analysis on Bank of America and on Ford. Earnings is on the 3rd. So I got today and tomorrow to think about that whole collar situation, but I think I'm going to call it just so I can sleep
I
better
think
at
you're
night.
locking it down. Are you kidding me? You've already in the bunker, and you're just wondering how much do I need? 72-hour kid? Do I need like that's 96? You're debating the food storage situation at this point.
Yeah, pretty much. Pretty
Yeah.
much. That's
And you know what? I don't care what the stock is. I don't care if it's the most aggressive or the most conservative. If somebody makes a decision to remove the personal volatility out of the equation, like, that's not a bad thing on earnings. There's a lot of time. You're going to have to navigate a lot of earnings in an investment. You'll get there very quickly after maybe 4 or 5 where you're like, I don't even care if it goes up on earnings. Just get out of here.